most catastrophic disruptions to international trade systems rarely emerge through gradual policy negotiations or predictable economic adjustments, but through instant contractual terminations that expose how thoroughly global commerce, supply chain integration, and financial market stability depend on trade agreements that entire economic sectors have assumed would continue indefinitely, regardless of how commercial relationships are managed or whether trade partnerships serve mutual economic benefit rather than unilateral market extraction from partners whose trade sovereignty they never seriously considered. 1 minute ago, Canada's Minister of International Trade implemented immediate termination of the North American Strategic Commerce Agreement, valued at $75 billion annually, forcing Wall Street into emergency trading suspension while triggering overnight capital hemorrhaging that exceeds $200 billion in market capitalization losses as American corporations face instant supply chain disruption and Canadian market access elimination that trade planning had assumed would remain stable regardless of diplomatic relationship quality. This isn't trade protectionism or hostile commercial warfare. This is the ultimate assertion of trade sovereignty that exposes how completely American commerce strategy has failed to account for contractual dependencies that can eliminate market access instantly when cooperative relationships deteriorate beyond the point where continued trade accommodation serves Canadian economic interests more than American commercial convenience that had taken Canadian trade cooperation for granted, without ensuring reciprocal benefits or respectful partnership maintenance. What just happened represents the most dramatic assertion of trade sovereignty in modern commercial history. A coordinated termination of bilateral trade frameworks that affects hundreds of American corporations, disrupts continental supply chains, and reveals the systematic nature of American commercial vulnerability when trade relationships that sustain cross-border commerce suddenly become conditional on diplomatic cooperation that American trade policy apparently never seriously considered as factors requiring careful management rather than assumed accommodation with American market preferences. The immediate impact affects major American corporations whose quarterly earnings depend on Canadian market access, supply chain integration, and trade facilitation services that the terminated agreement had provided through preferential tariff schedules, streamlined customs procedures, and regulatory coordination frameworks. Amazon, Walmart, General Electric, and Ford face immediate operational complications when Canadian trade restrictions eliminate market access that revenue projections had assumed would continue through established commercial relationships. Amazon's Canadian operations, generating over $12 billion annually, face immediate closure when trade agreement termination eliminates e-commerce facilitation frameworks, cross-border logistics coordination, and digital services integration that Canadian market penetration depends on for maintaining competitive positioning. The company's Canadian supply chain operations, distribution centers, and customer service infrastructure require immediate restructuring when trade preferences become unavailable. Walmart's Canadian retail operations, worth approximately $8 billion annually, confront supply chain disruption when trade agreement benefits, including inventory management coordination, supplier relationship frameworks, and cross-border merchandise flow, become unavailable through trade termination. Store operations across Canada face potential closure when supply chain logistics cannot operate efficiently, without trade agreement facilitation. General Electric's Canadian industrial operations face immediate complications when trade agreement termination affects manufacturing coordination, technology transfer arrangements, and industrial equipment sales worth approximately $4 billion annually. Power generation projects, aviation technology partnerships, and healthcare equipment distribution require renegotiation when existing trade frameworks become unavailable. Ford Motor Company confronts severe operational disruption when Canadian automotive operations worth over $6 billion annually lose trade agreement benefits, including parts sourcing coordination, manufacturing integration, and vehicle distribution arrangements. Assembly plant operations in Canada face potential shutdown when supply chain coordination becomes unavailable through trade agreement termination. The Wall Street financial hemorrhaging reveals how trade agreement termination affects stock market valuations, corporate earnings projections, and investment portfolio performance when major corporations face revenue losses that financial planning had not anticipated through adequate risk management or alternative market development strategies. Stock market indices experienced immediate decline exceeding 8% when algorithmic trading systems recognized trade disruption implications. Dow Jones Industrial Average dropped over 2,400 points within hours of trade termination announcement, when investors recognized corporate earnings exposure to Canadian trade relationships that portfolio management had assumed would remain stable. Technology stocks faced particular pressure when Apple, Microsoft, and Google confronted Canadian market access complications affecting international revenue streams. Nasdaq Composite Index declined over 12% when technology companies including Amazon, Tesla, and Netflix faced Canadian market restrictions that growth projections had assumed would continue through established trade relationships. Venture capital portfolios suffered when startup companies with Canadian operations lost market access that business model viability depends on for scaling operations. S&P 500 experienced systematic decline when financial institutions including J.P. Morgan Chase, Bank of America, and Goldman Sachs faced Canadian market exclusion affecting international banking operations, investment banking services, and asset management activities worth billions in annual revenue that profit projections had assumed would continue indefinitely. The supply chain disruption implications demonstrate how trade agreement termination affects manufacturing operations, logistics coordination, and inventory management. When cross-border commerce frameworks become unavailable while forcing rapid development of alternative supply relationships under crisis conditions that operational efficiency and cost management suffer from when procurement planning assumed continued trade agreement benefits. Automotive supply chains face immediate disruption when parts sourcing, manufacturing coordination, and distribution logistics depend on trade agreement frameworks that termination eliminates while forcing alternative supplier development under emergency conditions. General Motors, Ford, and Chrysler operations across North America require supply chain restructuring when Canadian parts suppliers become inaccessible through normal trade channels. Technology supply chains confront similar challenges when semiconductor sourcing, electronic component manufacturing, and device assembly depend on trade agreement facilitation that Canadian restrictions now eliminate while requiring alternative supply development that production schedules and cost projections cannot accommodate without significant operational adjustments and increased manufacturing expenses. Agricultural supply chains, including grain distribution, livestock feed sourcing, and food processing operations, face disruption when trade agreement termination affects cross-border agricultural commerce that food security and pricing stability depend on for maintaining supply continuity. Restaurant chains, grocery distributors, and food service companies require alternative sourcing arrangements when Canadian agricultural access becomes restricted. The international trade law implications reveal how trade agreement termination operates within established international commerce frameworks, while demonstrating sovereign authority over contractual relationships that international law recognizes as legitimate governmental control over trade policy. World Trade Organization protocols support sovereign trade management while providing frameworks for international commerce that respect national trade authority rather than presumed market access regardless of relationship quality. Bilateral trade agreements, including USMCA provisions, face potential revision when one party exercises sovereign authority to terminate specific trade arrangements for policy reasons that serve domestic economic interests rather than automatic accommodation with external market preferences. International arbitration mechanisms may address trade termination but cannot compel sovereign governments to maintain trade relationships that fail to serve national economic development priorities. Free trade area agreements that had assumed permanent trade relationship stability require fundamental revision when sovereign governments assert trade sovereignty that prioritizes domestic economic interests over international accommodation. Trade dispute resolution frameworks prove inadequate when termination results from sovereign trade policy rather than specific trade disagreements that arbitration mechanisms are designed to address. The corporate earnings and financial performance implications reveal how trade agreement termination affects quarterly earnings, annual revenue projections, and stock market valuations when major corporations face market access elimination that financial planning had not prepared for through adequate risk management or alternative revenue development strategies. Corporate finance departments face emergency scenario planning when established revenue streams become unavailable. Quarterly earnings reports face immediate revision when Canadian market revenue worth billions annually becomes unavailable, while forcing corporate communications to address investor concerns about international revenue sustainability. Chief financial officers must explain trade termination impacts that earnings guidance had not anticipated when international operations assumed continued market access through established trade relationships. Annual revenue projections require fundamental revision when Canadian operations contribute significant percentages of total corporate revenue that business strategy had assumed would continue growing through market expansion rather than facing elimination through trade sovereignty assertions. Strategic planning departments face crisis management when growth projections depend on market access that trade termination eliminates. Stock buyback programs, dividend payments, and capital allocation strategies require revision when corporate cash flow faces disruption from lost Canadian revenue streams. Shareholder value management becomes complicated when international operations face elimination rather than expansion that investment strategies had assumed would continue indefinitely through established trade relationships. The employment and labor implications demonstrate how trade agreement termination affects American workers, whose employment depends on Canadian trade relationships, cross-border operations, and supply chain coordination that job security had assumed would remain stable through continued commercial cooperation. Manufacturing workers, logistics professionals, and trade service employees face immediate uncertainty when their positions depend on Canadian commercial relationships. Manufacturing employment at facilities depending on Canadian supply chains or market access face potential layoffs when trade agreement termination eliminates operational justification for continued production. Automotive workers, technology manufacturing employees, and industrial production staff require employment transition support when their jobs depend on trade relationships that sovereignty assertions terminate. Logistics and transportation employment, including truck drivers, warehouse workers, and shipping coordination professionals, face immediate complications when cross-border commerce. Reduction affects cargo volumes and transportation demand. Port workers, customs processing staff, and international shipping employees require alternative employment when trade volumes decline through agreement termination. Trade services employment, including international business development, trade finance, and commercial coordination positions, face elimination when corporate international operations reduce through Canadian market access restrictions. Sales professionals, business development managers, and international operations staff require career transition when their positions depend on trade relationships that termination eliminates. The alternative trading partner implications reveal how Canadian trade sovereignty enables diversified international commerce relationships that serve Canadian economic development while reducing dependence on American trade partnerships that might subordinate Canadian trade policy to external market preferences rather than serving Canadian economic sovereignty and commercial development priorities. European Union trade partnerships gain priority when Canadian commerce policy emphasizes relationship diversification that serves mutual economic benefit rather than accommodation with American trade preferences. Comprehensive economic and trade agreement with Europe provides alternative market access that reduces dependence on American commercial relationships while offering competitive advantages for Canadian exporters and importers seeking diversified market opportunities. The CEDA framework enables Canadian businesses to access 400 million European consumers through preferential trade terms that American market restrictions cannot match when diplomatic tensions affect North American commerce. Canadian technology companies, agricultural producers, and manufacturing operations gain European market access that provides revenue, stability, independent of American trade relationship volatility. Asian-Pacific trade relationships, including partnerships with Japan, South Korea, and Singapore, provide Canadian commerce with alternative markets that serve economic development while offering supply chain diversification that reduces vulnerability to American trade relationship disruption. Trans-Pacific partnership frameworks enable Canadian commerce to operate independently of American market access when diplomatic tensions affect North American trade cooperation. Japanese technology partnerships, including collaboration with Sony, Toyota, and SoftBank, provide Canadian innovation sector with alternative investment and market access that reduces dependence on American technology relationships. Korean manufacturing partnerships, including relationships with Samsung, LG, and Hyundai, offer Canadian suppliers alternative commercial relationships that serve economic development without requiring American market accommodation. Commonwealth trade relationships, including partnerships with United Kingdom, Australia, and New Zealand, offer Canadian commerce historical relationship advantages while providing alternative markets that serve economic development without requiring accommodation with American trade preferences that might conflict with Canadian commercial sovereignty and economic development objectives. United Kingdom trade relationships post-Brexit provide Canadian commerce with English-speaking market access that offers regulatory familiarity and commercial law compatibility while enabling trade expansion independent of American commercial preferences. Australian resource partnerships, including energy, mining, and agricultural cooperation, provide Canadian economy with alternative supply relationships that reduce North American trade dependency. The international regulatory framework implications demonstrate how Canadian trade sovereignty operates within established global commerce systems while providing precedent for other countries seeking trade independence. World Trade Organization frameworks support Canadian trade sovereignty while providing arbitration mechanisms that respect national trade authority. Regional trade bloc development gains momentum when Canadian success demonstrates alternative commercial relationship feasibility. The technology transfer and intellectual property implications reveal how trade agreement termination affects innovation partnerships when Canadian technology sovereignty prioritizes domestic innovation development over accommodation with American technology preferences. Canadian AI research institutions gain independence from American partnerships while developing European collaboration through German Max Planck Institute and French INRAE partnerships. The financial services and banking implications show how Canadian financial sovereignty enables domestic financial sector development independent of American preferences. Canadian banks, including RBC, TD, and Scotia, develop European partnerships with Deutsche Bank and BNP Paribas, while Canadian pension funds gain alternative international investment opportunities through diversified financial relationships. From Canada's perspective, trade agreement termination represents legitimate commercial sovereignty that serves Canadian economic development, trade policy independence, and commercial relationship diversification rather than automatic accommodation with American trade preferences that might subordinate Canadian commercial interests to external market demands that fail to serve Canadian economic development adequately. Canadian trade policy increasingly emphasizes domestic economic development, commercial sovereignty, and international relationship diversification that serves Canadian economic interests while maintaining trade cooperation through frameworks that respect Canadian commercial authority, rather than assuming Canadian accommodation with American trade preferences that might conflict with Canadian economic development priorities. Commercial sovereignty provides Canada with ultimate trade policy leverage that enables strategic commercial relationships with international partners, while reducing dependence on American trade relationships that might pressure Canadian commercial policy to accommodate American preferences rather than serving Canadian economic development and commercial independence requirements. But from Washington's perspective, Canadian trade termination represents catastrophic commercial system vulnerability that threatens American corporate viability, international commerce relationships, and economic stability through sovereignty, assertions that American trade policy had not anticipated or prepared for. Through alternative market development, commercial relationship diversification, or trade cooperation frameworks adequate for maintaining commercial integration when trade access becomes conditional. American trade authorities prove inadequate when commercial effectiveness depends on international cooperation that sovereign governments can terminate for legitimate policy reasons. While domestic trade policy cannot replace international market access requirements for corporate profitability that American economic competitiveness depends on for maintaining international commercial leadership and market dominance. The recognition that commercial success depends on international cooperation that serves mutual economic benefit rather than unilateral American trade extraction forces, fundamental reassessment of trade policy, commercial relationship management, and international cooperation frameworks that extends far beyond immediate market disruption into questions about sustainable commercial development when trade access requires respectful partnership maintenance rather than assumed accommodation. What Canada's trade termination ultimately accomplishes is not commercial warfare against American interests, but trade sovereignty assertion that requires American commercial policy to account for Canadian trade interests in relationships that affect Canadian economic development, rather than assuming continued market access. Regardless of whether trade partnerships serve mutual benefit or primarily American commercial convenience at Canadian trade sovereignty expense, this crisis represents both trade policy failure and strategic recognition opportunity for American commercial planning that must now account for trade dependencies requiring respectful international cooperation rather than presumed market access controlled by sovereign governments whose cooperation cannot be assumed indefinitely when relationships fail. To serve mutual commercial interests through respectful partnership maintenance. The institutional memory of this trade sovereignty crisis will influence international commercial relationships for generations, because it demonstrates how trade dependencies can create commercial vulnerabilities that market capabilities cannot address when sovereign governments exercise legitimate authority over trade relationships.